Okay, hello. This is the Hartnett Flow Show walkthrough. You'll be able to take in the report three ways. You can look at the PDF on the left, which is also attached at the bottom. You can follow along with the commentary as I go through it here, or you can read the post on the right-hand side. Okay, here we go. Scores on the doors: crypto 91.7%, gold 29.5%, stocks 22.1%, high yield bonds 8.6%, US dollar 5.6%, cash 5%, commodities 4.5%, investment grade bonds 3.2%, government bonds minus 2%, oil minus 2.2% year to date. There is a decent amount of content in here, most of it concentrated in the last section. And we're going to go through that. Charts will be on the right as well. Zeitgeist 1, it's getting frothy. Even Tehran Stock Exchange hit an all-time high this week. Zeitgeist 2, Treasury price action this week. Suddenly cut, then inflation. That's a comment on how the markets reacted to the CPI and then the PPI. The biggest picture: Argentina, world's best performing stock market, is on track for a super rare budget surplus in 2024. See chart 2. As Malay engineers radical turnaround from 9% deficit in Q4 23. Meanwhile, U.S. government spending is up 11% year over year to $7 trillion. See chart 8. U.S. national debt on course to hit $40 trillion. Less than 400 days into the new Trump administration. Markets are front-running U.S. spending cuts. See the bear in defense stocks. And no love yet for treasuries. The debt restructuring in 2000, 2003, drawing your attention to the Argentina chart. That's when I spent time in Argentina. And that was when they were hopeful back then that the new administration was going to undo the socialism that they had to deal with coming in, and that did not happen. Now, this time is different in the sense that I think this is U.S. backed, but nevertheless, it's the beginning with U.S. backing. By contrast, the U.S. national debt is on course to hit $40 trillion in less than 400 days into the new Trump administration. And his second statement there: markets are front-running U.S. spending cuts. See bear in defense stocks. He's saying that while things look good, and he'll come back to this theme later on, there are cracks in the facade. So bear market in defense stocks would be an indication of that. An indication of a government that's going to spend less, not more, or on the path to reducing spending. However, there's no love for treasuries yet, so that would tell you that, hey, there may be some early signs of deficit spending reductions, but the bond market is giving no indication of that right now. Tail of the tape: AI's biggest ABB winner. AI is the biggest ABB winner. ABB meaning anything but bonds. Investor capitulation into AI leaders, trailing 62 times PE of the Magnificent Seven, greater than prior bubble highs. Equity breadth is poor, just 31% of the SPX outperforming. Very 1998, 1999-ish, chart 3. We have that up for you. But history shows only central banks end melt up. See bubble history, table 1. And Fed cutting rates next week. Rotate from stocks to bonds in 25, only once the Fed turns hawkish. Given the history of melt-ups and situations similar to this in the past he's pointing to, for example, 98 and 99, you would think that we're near the top or near the end. And he's saying that these things don't usually end until the Fed takes away the punch bowl and turns hawkish. And that would mean raising rates. And they're in the process of cutting right now. Not so sure if I agree with that 100%, but he has a table that goes with it that corroborates that. You know, it's a little bit small for you to see here, but the idea basically is when comparing the current Magnificent Seven bubble potentiality with prior proven bubbles, we are at a higher PE valuation compared to most of them. We're higher than the average, let's put it that way. But we are lower than the average rise. And so therefore, that would be one reason to say, hey, we're not there yet. We're below the average in several measures. He's giving into the bubble. The price is right. China 8 shares, 28%, outperforming the S&P 500 in 24. Trading easiest financial conditions since June 2020. Chart 5. Yes. China surplus just hit record high to almost, 957 billion equals 5.25% of GDP. Chart 6. Yes. China's share of global car production up from 1% to almost 40% in the past 27 years. Chart 7, as Europe is 34% to 13%. Japan is 21% to 12%, and the US is 12% to 3%. But Trump wants growth, not inflation. And if consensus is too fearful of Q1 tariffs, China's stocks set to outperform more. Entry for international in Q1. Generally speaking, he's saying that he's saying there's a good chance that China's outperformance will continue. And if the consensus is too fearful of Q1 tariffs, meaning if tariffs don't get implemented, then China stocks would outperform even more and also set more clearly the path out of US stocks into international stocks in general in Q1. This is actually, I think, a very clear path. The bottom line is, if you're thinking about buying Chinese stocks or international stocks versus US, the signpost or fork in the road comes if you believe that tariffs will not be implemented as proposed. Weekly flows, 10.6 billion into bonds, 8.8 billion into stocks, 4.1 billion into crypto, 0.2 billion into gold, and 11 billion from cash. Looks like everybody's deploying capital in anticipation of the December Fed cut. That's pretty clear to me. The question is, who's selling? Flows to know, crypto, 39 billion inflow year to date after record 119 billion. I'm sorry, not 119 billion. 19 billion inflow in the past 8 weeks. That's chart 11 on the left. High yield bonds, first outflow in 18 weeks, 0.3 billion, and record inflow year to date, 52 billion. US equities, 48 billion inflow year to date equals a record. Well, if there's record money, there's going to be record inflows. Pardon my editorial comment. China stocks, biggest inflow in 9 weeks, 5.6 billion. Chart 12, that's on the right there. Maybe hard to see on your screen. It's not a huge inflow. However, it's a big reversal from the previous couple weeks. It's almost like tapping into what Hartnett is saying here, that the market is finally looking at Trump's tariff threats as possibly not doable. And people are nibbling on Chinese stocks again. That's in combination with the fact that China is taking a easier stance publicly and telegraphing that they're going to be stimulating once again. Leveraged ETFs, 1.4 billion outflow this week, follows a 4.2 billion inflow in the prior 4 weeks. Healthcare largest outflow since February 25, 1.7 billion. The Trump flows to know. Biggest fund outflows as a percentage of assets under management since the U.S. election, chart 10. Let's see if I have that. I do. Crypto, 9.3%, bank loans, 6.7%, money market funds, 3.6%, leveraged ETFs, 2.5%, U.S. small cap, 2.4%. Biggest outflows. Treasuries, minus 0.6%, Japan, minus 1.1%, Europe, minus 1.3%, emerging market debt, minus 2.3%. Notice that everything is flowing into American exceptionalism and flowing out of international stocks, and this plays into probably what Hartnett is thinking is going to reverse as the year goes on. Let's take a look at that chart. Yeah, American exceptionalism, right? Everything into America and out of things that aren't American. You can throw the dollar on the left-hand side of that in the blue as well. And you could throw gold on the right-hand side of that as an emerging market, which I frequently do. So I think that gold is going to have a rough couple months. I don't hope it, but I'm prepared for it. B of A private clients levels. Not that significant of its own, but always good to compare to the institutionals, which is what we do in the charts that we present. B of A bull and bear indicator dips to 3.6 from 3.7 on outflows from high yield bonds, emerging market assets versus poor global stock index breadth. Sentiment positioning in global assets neither extreme bullish bearish as U.S. bulls offset rest of the world bearish. Remember, it's a global bull and bear indicator. B of A global FMS, December results, Tuesday, next sentiment data, FMS cash level below 4% equals a trading sell signal. Right. If there's not a lot of cash ready to go into the system, then you're going to have a dip coming. And or a rise in net overweight in global stock allocations above 52% would signal traders to take profits. Okay. Okay. The main discussion is the 2025 playbook. Now, it's a long, seemingly rambling paragraph, but we're going to break it down for you so that it's relatively easily digestible. Before going into it, we suggest that you look at this, not a playbook is what it is, but it's a path that he thinks that we're going to be on in 2025. So he thinks X gives birth to Y, and then he thinks Y gives birth to Z. To the extent that he's wrong or not right, he will adjust this during the year. But this is the path he thinks we're on now. And it's really a more detailed version of what he's been putting together over the past several weeks. And it's like a play in 3 parts. I'm going to give you a little hint how to read these when you're alone and not listening to me. When you see a long, long paragraph like that, every time you see a semicolon, that's the end of a thought. Okay? He uses semicolons like I would use the end of a bullet, or some people would use commas. So the yellow spots there are the end of his thoughts. That's how you keep all the commas together. All right, I'm going to go through each thought. I'm going to read it verbatim, and then I'm going to summarize it for you and what it implies. All right, 2025 playbook. Many moons until AI flips today's 2% U.S. productivity growth and 3.3 to 4% inflation to baseline of 2% inflation and 3 to 4% productivity growth. But AI is the catalyst for full capitulation into the US inflation boom and the global deflation bust. Q1 overshoot in US dollar and stocks. That's the end of the first thought. He believes that the benefits of AI will not be felt until long after the costs associated with its implementation are felt. That is inflationary. So the summary of this first point is, as we go into the first quarter, the benefits of AI, which would be to flip the inflation to the productivity, would not be felt until after we've spent the money, until after we've had a US inflationary boom and a global deflationary bust. So he thinks that the path that we're on will continue, and the anticipation of the benefits of AI are going to come well after the cost of AI. That's what he thinks going to happen going into Q1, meaning the dollar gets stronger even as inflation increases, and the benefits of AI are not felt yet. Point two, investors already heavily positioned for higher US dollar, higher US stocks, and higher bond yields. But the